Hi, folks. Dr. Cohen back here today, like it would be somebody else, right? Anyway, we're here to talk about some tangible and intangible assets. So, thing number one to know is tangible means you can touch them. They have physical being, like, I don't know, like this mouse, or, you can actually touch it. Intangible, you cannot touch it. Okay, so we're going to talk about that and long lived. Okay, or long lived, whichever way you want to pronounce it. Okay, so here we go. Right, so the first thing we have to do is we have to define them, we have to classify them, and then we have to explain these assets. Okay, and remember, they're assets, so they're going to be on the balance sheet. Okay, so remember, assets, balance sheet. All right, so the thing about assets, a couple of important things. Number one, they're for use over 1 or more years. Okay, so they're to be used for quite some time. They're not intended for resale. So we didn't buy in other words, these assets were not born for resale. Otherwise, they would be called inventory. Okay, tangible assets have physical substance, like a computer, like a machine, automobile, truck. And intangible, no physical assets. That could be something like a patent or a copyright or something called goodwill. And those are the things we're going to look at. Okay? So here's some examples. Land, assets that are subject to depreciation, buildings, equipment, furniture, and fixtures. Okay? And then intangible assets. They have usually value represented by rights that produce benefits. So patents, copyrights, those are subject to something called amortization. Okay? Intangibles with unlimited life, meaning an indefinite life. So some of them have a specific life, some of them have an indefinite life, and the indefinite ones are not amortized. Amortization, remember, is just like depreciation, but for intangible assets. Okay? All right, so here you go. Which of the following are intangible assets? This is question 1 from chapter 9. So make sure you write that down so you can take your quiz. You're not going to see the question, remember, just going to be able to pick A, B, C, or D. That's it. Okay? All right, objective number 2, the cost principle. How do you figure out what an asset costs? Okay? So when we acquire them. Okay? So we acquire this asset and we have to, how much of this, what are the items that we actually capitalize? And capitalize means to put on the balance sheet, right? Put on the balance sheet as an asset. Okay? So notice here, the first thing is the purchase price, okay, which you would expect that. And all reasonable and necessary expenditures to prepare it for its intended use, okay? And like I said, that means recording these costs is called capitalizing the costs. Okay, capitalizing means putting it on the balance sheet. Okay, so remember, you have to get this thing ready to use, and this is for tangible assets. Okay, so if it's something that you need to get this thing ready to use, it gets capitalized with the cost. Okay, and we're going to take a look at some of those items. Okay, so for example, if it was land, you could have the purchase cost, legal fees, survey fees, title search fees, all of those would go together for that land. What if it's a building? The construction cost, any legal fees, appraisal fees, architect fees. What if it's equipment? The purchase, sales tax, transportation, installation, all of that becomes part of it, okay? So you got to keep in mind, when we say the historical cost of this item, what are we talking about, okay? Oh, so here you go. Which of the following would not be capitalized as part of an asset? What would not be? Not be. Okay? So this is question number 2 from chapter 9. Make sure you write down your answer here, just the letter. That's all you're going to need when you go to take your quiz. Okay? All right. So now what happens if you buy stuff together? Like you buy stuff in a package. Okay, sometimes we get stuff bought together in a package. It's called a basket purchase. So for example, here they give an example of a land and building. Okay, and what you do is you look at their relative market value. Okay, so if the total cost was $10 million, this is for the land and the building, and 40% of the value was for the land, it would be $4 million for the land, and then $6 million for the building. And by the way, this would be done through like an appraisal process, right? So it's going to be allocated relative to the proportion of their market value. Okay, so you'll have a, I don't know, like you'll have an appraisal, something like this, right? And that's how you'll be able to tell. All right, so let's take a look here. What a mess this is. Okay, well, let's see. I don't know why those things are. All right, so here we go. We'll just start with this. Cedar Fair purchased a new ride for $26 million. They got a $1 million discount. Okay, they paid $125,000 for transportation, $625,000 for installation. So it says prepare the journal entry for acquisition, assuming Cedar Fair signed a note payable for the new roller coaster and paid cash for the transportation and the installation cost. So they paid cash for transportation, $125,000, and installation. So that's $750,000. Everything else they paid for with a note. Okay. So here's what it would look like. Okay. So they got equipment total of $25,750,000, right? So there's their discount. I'm not sure where those lines came from. Okay. So there's the total cost there, right? So cash goes down by $750,000. Equipment goes up by $25,750,000, and then they have a $25 million note payable. Okay. So and here's the cash that they paid. So they got one big asset going up, they've got some cash going down, and the note payable of $25 million bucks. Okay. By the way, another thing that happens is maintenance incurred during the use. So here's the key. If the maintenance is ordinary and necessary, right, to keep it running the way it properly should, relatively small, notice they're small, reoccurring expenditures that maintain normal operating condition, right? Do not extend the life. So for example, tires, oil changes on a car, right? Now, extraordinary repairs, replacements, or addition, relatively large, infrequent expenditures, overhaul, may extend useful life, may extend increased productivity. So ordinary repairs and stuff, those are just expense. Those go on the income statement. That's just a regular cost that goes like that. Now, the other ones, the relatively large ones, let me move my thing here, they get capitalized. What does capitalized mean? Capitalized means it's added to the asset and then it's depreciated, okay? It's added to the asset and then it's depreciated. So let's say, for argument's sake, let's say there was an airplane. And on this airplane, you had to put 2 new engines on the airplane, right? So whatever the value of the airplane was, they're going to take those 2 engines and add them to that value. Then they're probably going to adjust their depreciation because by adding those 2 airplane engines, they've extended the life. So they're probably going to have to adjust their depreciation. Now, let's say on the other hand, let's say somebody had a delivery truck and the delivery truck needed a new set of tires. Well, tires are just a normal thing that you have to have. It's a regular cost. Same thing with an oil change, okay? By the way, don't overthink it. Some people tell me, well, tires last for a long time. Don't go there. Don't make yourself, you'll think yourself in a circle, okay? If it walks like a duck, quacks like a duck, probably a duck, okay? So don't make yourself crazy. All right. Company needed to put a new engine in one of its delivery trucks. What should they do? What should they do? Okay, that's question number 3 from chapter 9. Okay, don't forget, this is going to be on that quiz, right? So make sure you write down A, B, C, whatever it is here, so you can take that quiz. All right. Now, we're going to talk about depreciation. I'm going to stop it right here because depreciation is really important. You're going to see a lot of this on your test. We're going to go through the different methods and stuff. Okay, so make sure you understand it. And don't forget, if you don't understand, you got to ask questions. Okay, got to ask questions. That's how you learn. All right, folks, we'll be back with part 2 in just a minute.